Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. Now, when it comes to retirement, of course, you spend your entire life working towards it, and then when you reach there, sometimes you're faced with more questions than you began with. What do I do with my time is sometimes the most important question to ask. But on today's show, I'd like to deal with a checklist that you can possibly follow to kind of put things in perspective, because it's such a large concept that it sometimes helps for somebody to tell you, okay, this is a list of things for you to do. Don't worry, just check them off and you'll be fine. To talk about this, I'm joined by Mrin Agarwal, financial educator and founder of Finsafe India. Thanks so much for taking the time, Mrin. I asked for you to make a checklist of what somebody should do if they're retiring this year. And I think it's a pretty comprehensive list. Let's run through it. The first and the second points are actually pretty important, just from the perspective of taking stock. What are they?
So, thank you for having me on the show, Alex. Always a pleasure to be
My
here.
pleasure.
And I think, the first thing is really about, making your retired life simply simple. And the first step towards that is really about consolidating all of your accounts. You know what happens over the years, people tend to actually have a lot of accounts all over the place, a lot of investments all over the place. And the idea is, can I really consolidate? Like, so for example, have just two bank accounts because you really don't need more than that, right? Similarly, all your other accounts as well, if you have a lot of accounts here and there, different financial accounts, of course, you'll have to figure out which are the ones that you want to keep. Secondly, try to hold as many financial documents digitally, right? And today it's highly possible because, for example, the NSDL cash that one receives on a monthly basis, right? This covers mutual funds, bonds, stocks, the sovereign gold scheme, NPS as well, right? So it's a very good statement because not only does it tell you what are the holdings, it also shows the transactions. And, at the bottom of the statement, they've also mentioned the holding and whether there's a nominee and all of that. So I think it's very important that, first of all, if you don't have the NSDL cash coming to you, then go to the website, sign up for it, get your NSDL cash. Another very important aspect is DigiLocker nominee. So now there is a feature that's available where you can put a information nominee in the DigiLocker. And what happens is that once a person's, so this basically helps in transmission of assets. So once a person's death is communicated, then what the DigiLocker does is that it pulls all the investments. And of course, DigiLocker also has insurance details as well. So it pulls everything and gives the information nominee a view of everything that the deceased held. Now, I think this is a very important step for anybody to do, given the fact that we have 1 trillion of unclaimed assets in India, and the prime reason being that people not making their family aware.
Yeah.
The other thing, of course, which is a little cumbersome, is to make a list of all gold jewelry that you own, for example, or any physical holdings that you have. Better to document it.
Yeah, well, for me, at least, Mrin, that's going to be really simple to do because I just have one. It's on my, it's on my finger. But having said that, let's talk about the third point, which is loans, right? And this is something that I think a lot of people need to come to terms with, because I'm hearing of 54, 55-year-olds that are also contemplating taking loans. This is normalized. And of course, you have your ages that are going up, your living expectations are going up substantially. I think financial institutions are also comfortable with that. But is there a good idea here to pay loans off very quickly?
Oh, absolutely. I mean, I think, you want to get into the retirement phase to be really your happy phase without having all these responsibilities of repaying off loans. And I think, very importantly, and, you actually said rightly, because I know that there was an RBI study that was done many years back, which actually showed that people actually increase their mortgage loans as they head towards retirement. And I would think now, from what I see, I think people are actually increasingly taking education loans, in their 50s to basically support foreign education for their children. So I think, one has to think about this very, very carefully. Really think about whether you want to carry the loan through. And of course, the ideal situation is to repay the loans. But I think, one of the things that we always, as Indians, that we never hesitate to do and we never want to do is look at taking loans against our assets. So everybody's got a lot of gold just lying there doing nothing. Utilize it. So instead of, even if you think that you want to take that education loan, maybe you could look at taking a loan against gold, or you could look at taking like a reverse mortgage or something like that, wherein you're utilizing the asset and of course getting it at a lower interest rate then.
Yeah, it's a fair point. But bear in mind, of course, that gold loans are relatively lower tenor loans. They don't generally
Yeah.
give you loans that are very long. And so from that perspective, may not necessarily meet the goal of an education loan. It can tide you over for maybe a tuition fee or maybe a hostel requirement or something like that. Maybe a part of that, Mrin. But having said that, let's talk about emergency funds as well, because, of course, people have a sizable amount of corpus set aside. They just need to apportion a portion of it, right?
Yeah, of course. I think they need to have 6 months going towards emergency expenses because, of course, emergencies can happen at any point in time, and you want it to be in an instrument that is easily accessible at the time of need and which you're not utilizing for another purpose. So, many times people say that I have fixed deposits, it's giving me that monthly income that I need. So, can I just not use that? So, I would still say that have a separate amount kept for emergency fund, and I would think that the fixed deposit is the best way to really do it.
And if you have a credit card, of course, that's another avenue, right? It's an access to a credit line, which allows you that liquidity when you need it. And of course, I've actually heard a lot of senior citizens say that they can't get credit cards anymore. So it's best taken when you're still earning, right?
Yes.
Okay, so let's talk about insurance as well, because this is a pain point, I think, for a lot of people, Mrin. Best taken beforehand, and that carries through. But what do you do to ensure that you're adequately covered?
So I think the first thing is to have a huge focus on health insurance. If you haven't taken life cover till now, then I think it's too late to take it right now. But certainly, health insurance is really required and important given the rising medical costs and inflation that we have in India. So, if you are a salaried employee, then please look at porting the existing group health cover that you have available with your employer into an individual plan. And for that, you'll have to start the paperwork 45 days before the retirement. So please look into that and certainly look at doing that because remember, when you port the policy, then all the waiting periods are already taken into account, right? And typically, you see that the group health cover are at more favorable terms for the individual. So certainly, I would say look at porting the policy if you're a salaried employee. And other than that, from an individual perspective, a low cost option to buy a health insurance is the super topper plans. You do have standalone super topper plans that are available in the market. Of course, it's very important to check what are the exclusions in the policy and also what are the waiting periods. The claim ratios, claim ratios get published by the regulator. The rest of the information is available in the customer information sheet, or I think they have some sort of a thing available on the insurance company website. So I would actually say that if you need to buy an additional cover, then take the super topper plan. And the third thing would be that in case if your children are working, and if their employer provides a parental insurance, then do take that because again that comes at pretty favorable terms, and it's good to always have that extra cover.
Yeah, fair point. Of course, the super top up is what kicks in after either an existing base policy is used or you pay a certain amount and then after that it kicks in, right? So what Mrin is saying is that this is significantly costly. Of course, you best get advice on these things because it's usually a trade-off. You will have to give up certain things in order to get a lower cost. Ultimately, it's an actuarial science. They will weigh the pros and cons, the risks, and give you a rate. Let's talk about investments, Mrin, and this is where a lot of people have to transition sometimes from having taken more amount of risk to not taking as much or sometimes not taking enough risk as well.
Yeah, so I think, where the investments are concerned, I think the first thing is to really put down everything on a piece of paper, what all you have, right? Now, again, Alex, in most cases, what you'll find is that you would have invested in some NFO, somebody would have told you, or you would have invested in some thematic fund, or, you would have bought some IPO and stuff like that. So first thing is, be very, very clear about your core portfolio being simple, consistent funds that can be held for the long term, which, according to me, are your typical Nifty 50 index fund, flexi cap fund, maybe a mid cap fund, right? Now, all of this sector funds, thematic funds, or whatever you've done, because somebody told you and then you've not kept track of it, that needs to go, right? Second thing, you need to check if there is some overexposure towards certain assets. So again, typical in Indian families, very, very high exposure to insurance plans, a high exposure to gold, and for all the noise around equity, you'll have only about 5 to 10%. I think you need to also look at the overexposure that you have. Also, like, if there are certain schemes that you bought last year, for example, silver ETF would be one such scheme that somebody might have invested last year and now they're seeing it at a negative. So again, I think it's important that you look at what are the schemes that you have and figure out what is the fit for these schemes in my portfolio. Do they have a fit or not? And I actually believe that if they don't have a fit, it's okay. Cut your losses and just move on. So I think that is the first part on the entire consolidating your investments into simple few investments. Like you don't need more than 5 to 7 funds in the portfolio, and that should be good enough for you. Now, how do you plan for the regular income? Because that is very important, right? So, couple of things. Of course, if you're retiring, once you've become a senior citizen, then you have all these senior citizen savings schemes, and otherwise, also you have the post office MIS, you have fixed deposits, you've got the RBI floating rate bonds. Please remember, all of these schemes are going to be fully taxable. So, depending upon your tax bracket, you decide whether to get into them or not, right? Next thing is that if you are holding NPS, right? So, from the 60 or 80% lump sum, whatever it is, now you can actually put a systematic withdrawal plan from there. The balance amount, in any case, 20 to 40%, whatever is there in annuity, you can opt for annuity for joint life, which is you and then followed by your spouse, right? With the return of purchase price. And most importantly, right now, Alex, because we are seeing so much of focus on the systematic withdrawal plan in mutual funds, it is something that actually has to be planned a couple of years before retirement. And it is something that needs to be done from debt funds. I've come on your show earlier, and
Yeah.
I know you've done a show on SWP. So I think, these are some of the options that you can look at for a regular return. Now, lastly, how do you design your portfolio? So, again, please take the help of a financial advisor. It's very easy for me to just come and say all this, but in reality, when you try to do all this, it's not easy. So, take the help of an advisor. And, I could just say that, look, you could look at having a bucket strategy, which is the first 5 years of your expenses, you put aside in instruments that give you a regular return. And the balance amount, then you can take a little bit of risk. Maybe you could look at a balanced advantage fund sort of an instrument, plus the regular rebalancing. I think very, very important is, what not to do is fall for high fixed return schemes. Number one in my list right now is corporate bonds, or, this gold saving scheme from the jewelry shop, right? All of these schemes that promise very high returns and look too good to be true. Again, don't fall for influencers and all of those things. I think the idea is keep your portfolio really, really simple.
Yeah, you said it. And there are a few more things, of course, that you've listed out. And if you will permit me, I will read through them because we're running out of time. You've said make a will through a lawyer. Very, very important, because it's very, very important to ensure the transfer of your assets is done the way that you want it to. Keep your partner informed and involved in the process. Now is the time to do that if you haven't done it in the past. Decide what you're retiring to. Maybe read a book. Ikigai is a good one to start with. And finally, spend some time to figure out what level of support you would require from your family as well. Mrin, it's been an absolute pleasure speaking with you. Thanks so much for taking the time.
Thank you.